when good news is bad news. Hi, it's Charlie giving you Saturday's video. And in the stock markets right now, we're in this narrative at play whereby the stock markets are almost cheering any economic releases which are weak. So the stock market likes it when an economic release comes through which is weaker than expected. So with yesterday's, I'm recording this today, Friday, but you're watching this Saturday. With yesterday's non-farm payrolls coming out so strong and a real a solid beat on the upside, 528,000 jobs created as opposed to 250,000 expected, plus the average earnings, hourly wages increasing as well. So a solid beat there. And so we've got much stronger jobs report, and yet the markets then sell off. Now, I'm recording this at 5 p.m. or so UK time, and we'll have to see how the Nasdaq closes at the end of the day. But certainly they've sold off on that initial news. So good news. Stock markets aren't liking it because good solid news like that equals what? Higher potential interest rate rises. So all the time the Federal Reserve think, well, the economy can take this. They'll carry on their path of rate hikes. So all of a sudden the odds today jumped up from like 40% to 70% plus probability on the back of today's report of the Federal Reserve going for a 75 basis point hike at the end of in September. So hence why the stock market sold off. So sometimes you have to look beyond the headline figure and say, well, what's the market looking for? What's the stock market looking for? The stock market wants cheap money, and unfortunately at the moment any positive economic releases actually equal not so cheap money, because it means the Fed can hike. Now, next week we have the inflation report coming out next Wednesday. And so that's what the market is going to be looking for next week. So we've got past today, we've got past non-farm payrolls. We've had a reaction to that thus far. Are we going to see a hot inflation report? Now, what we already know, the inflation report is projected, the estimates are already sitting there for next Wednesday to come in. The forecast is at 0.2%. Last month it was 1.3. So it's already taken into consideration before people say, well, what about falling oil prices? And with oil coming down, generally speaking, and we're seeing commodities coming off as well. So we certainly should be seeing a much lower print in inflation next week. But then that is forecast for a much lower print. So really it's just a case of, does that inflation figure of forecast of 0.2%, does it come in even weaker than that? And so if that's the case, going back to the stock market, and the market's always trying to throw us off whatever goes on. So if we go back to the Nasdaq, in fact, here that's the S&P, but I'm quite liking the Nasdaq because I do like that trend line that we've got here across these highs and this respective channel here as well. So if we see weaker inflation figures than forecast next Wednesday, then all of a sudden we could see these markets coming back up again, because then if we've got lower inflation, then the Fed doesn't have to necessarily put its foot down as hard. So as interesting as the non-farm payrolls report's been today, we might still find a softer inflation report next week sends the markets back up again. So always important to look at the narrative of what's going on in the markets. At the moment, it's all about inflation, and the byproduct of that is whether the Fed needs to keep putting its foot down. So the jobs report has certainly given us that heads up that yes, the market, the jobs market is still very low inflation. The market can take it for the time being. That's how the Fed will see that. But if inflation comes down significantly and comes in lower than forecast, then we could then still see the stock market cheer that. So, because then it comes back down to, does the Fed need to hike as aggressively? So it's all a game, isn't it, that we have to constantly navigate our way through in the market. But for now, what we've seen today is a Nasdaq which has come up to a long-term trend line here, which started back at the beginning of the year. I've got a channel on here as well, and of course it's into horizontal prior highs here as well, and lows from back here. So it's a nice reaction that it's had. But I am only recording this at 20 past 5 Friday evening. It'll be interesting to see how this ends up closing. Maybe it rallies into the close, but if it doesn't, then we can say yes, hot jobs report, but actually sending the stock markets down on the day. That's the narrative to be watching out over the coming weeks. And in line with that narrative, we're looking at the dollar, of course, as well. The dollar's benefited from this today as bond yields have risen in line with those new expectations of a higher interest rate hike coming again in September. And in line with bond yields and the market looking at those for the potential for higher interest rates, that acts as a tailwind here to the dollar. But again, if inflation figures come in lower than expected next week, all of a sudden we could be back down, and all of a sudden the dollar is looking at this trend line here for a potential break. So we've got to stay on our toes for now. This is looking like a positive for the dollar, and we'll see if the dollar can get back through my daily 20 here on the daily charts, then all bets are off and maybe the dollar goes back to new highs. If not, and that inflation report comes in softer than expected, the dollar's back down at this trend line, then do look out for a potential trend line break. So it's fairly straightforward at the moment. It's just that which way is it now going to go on the back of next week's inflation report. There you go, some food for thought this weekend. I hope you have a lovely weekend, and I'll be back in touch next week.